IFRS 10 looks at consolidated financial statements. And a key element to IFRS 10 is it defines when a company has control over another. And that's essential because if one company controls another, they form consolidated financial statements, which means they add in 100% of the assets, liabilities, income, and expenses of the company that they control. Now, as part of that, we need to look at the definition of control. And it states that a company has control if they have power over the investee, if they're exposed to or have the rights to variable returns, and if they can use that power to affect the amount of returns. Now, to dig into that term power a little bit more, IFRS 10 says that the company has power if it is able to direct the relevant activities of a business. And that is what you would imagine it to be. Things like setting selling prices, determining what to sell, capital expenditure. So really taking a sensible approach at who's really running this business. A good example of this can be found in Disney's consolidated financial statements. Now, Disney owns many theme parks globally. It has 6 theme parks globally, and it owns 100% of the 2 in America and the 1 in Paris. And that leaves the 3 Asian theme parks. Interestingly, Disney doesn't own the majority of any of the Asia theme parks. In Japan, it actually doesn't own any of the Tokyo Disneyland. It just has a royalty agreement, so all that's recorded in the financial statements is one line of the income from that. For Hong Kong and Shanghai, Disney actually owns less than 50%. Normally, we would think that that doesn't represent control. But because of a contractual agreement where they have the right to set prices, to open rides, and to really develop those parks, it is deemed that they do have power. So what that means is they can consolidate all of the assets and liabilities and income and expenses of Hong Kong and Shanghai, even though they really only get around 46% of those profits. And that has a big impact on their financial statements because that would mean that effectively 40% of their theme parks wouldn't be consolidated if you just based it on the percentage that you actually owned. So IFRS 10 gives a great, clear guidance of how companies could be able to consolidate even if they don't own the majority of shares in a business.